Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. It's my great pleasure to present today's video on Owens Minor, but more importantly, it's also my pleasure to also get an opportunity to discuss the difference between price and value. So allow me to start out by first evaluating what kind of company Owens Minor actually is. In other words, is it a high growth stock? Is it a dividend growth stock? Is it cyclical? What kind of businesses I'm looking at? That's always my first goal. And what I've got on the screen here is Owens Minor with operating earnings only. And just so that we're clear, what I see here is I see a company that has decent growth. Now, the number found in the Fast Facts box here is 8.9%. However, that includes estimate data. And I've got earnings estimate data going all the way out to 2020. And you can see these 3 years are pretty high, 21%, 15, and 24, which obviously increases that number. But watch as I start to scroll out some of these what I call high estimates, and all of a sudden now my growth rate is down to 8%. And the reason I'm showing this, I talked about this in the written portion of the article. This is a quasi-cyclical company. I refer to it as, others might even consider it just purely cyclical. But the reason I say quasi, they string together, 5 or 6 or 7 years of good growth, and they have a down year. Then they string together another 4 or 5 years of decent growth with a little slowing in a couple years. They go through the recession like it wasn't there. But I want you to notice that you can really see it here, that the earnings growth has flattened quite a bit. So this is really, from a standpoint of evaluating valuation here, you've got multiple valuation multiples because here you've got an 8% growth rate. Now, all I've got to do is eliminate this one down year. We had a minus 13% growth in 2017. And watch what happens to this growth rate number right here in this Fastbacks box as I just simply take out this negative year. This is the dynamic nature of earnings growth. Now all of a sudden I'm back up to 9.4% because I simply took out that number. I scroll back just a little bit more and now my rate is 9.8%. But now if I take out this high growth rate here, the 14% growth rate, watch what happens. My growth rate now drops down to 9.5%. And likewise, if I shorten the graph the other way and just look at these last, these 4 or 5 years in the middle, you actually see a negative growth rate. Now that's going to have an impact on valuation because when I open this graph up for you, all right, and I set everything back to normal, so I'm going to pull the slider here and go all the way back to 1999 through 2020, which is the estimate data. And now I'm going to bring monthly closing stock prices onto the graph because this is important. Now, before I do that, though, I'll make a couple of points. By checking the Fast Facts box, I know that this orange line is a PE of 15. Okay, no matter where you touch this orange line, you can see it at the bottom line there, it's a PE of 15. But I also want you to notice that the E is changing. Here you had the E go from $1.11 to 92 cents, but you still have a 15 PE here, but you now have 15 with low growth. That's going to have a great deal of effect on valuation. So as you're looking at a company like this, I see that it's cyclical. So now I'm going to try to get a perspective evaluation by bringing monthly closing stock prices into the graph. Now what's interesting here, I see a couple of things that I want to talk about. Now, first and foremost, this is a 15 PE ratio drawn across this graph. This is the real world. The reason I call this a valuation reference is because you can look at that as your reference and know, like you can tell right here that the stock was trading at approximately a 15 PE. You also know that it was higher than that. But I also want you to see something else. I want you to see the general direction of the price goes where the earnings go. Now, there's a lot of volatility in between, but like if you look at this stretch right here in the middle, this is kind of an interesting stretch to look at. If you'll kind of bear with me a little bit, I'll go ahead and scroll into that area. If you look at that area there, you see that the growth rate was really quite low. You're only looking at 3%. I go back 1 year where you had this great 37%. So all I'm trying to explain here is this is just mathematics. As you look at this company over different time frames, like from 2009 to 2014, it only grew at 1.3%. So this is still a good valuation reference, a 15 PE, if you will. But it in itself, it's also relative to the growth rate. It's not going to be a great investment if there's no growth. For example, from here, you bought it at fair value, 15 PE, a little high. And then here you're back down, you're down a slightly less, but you actually would have lost money over this period of time, 2-year period, 2010 and 11, I guess it is, or excuse me, 11 and 12. The point is that, the stock price kept reverting to the mean here, going up and down, but because earnings growth was actually negative. It went from, we had 4% growth in the previous year, then it went to 0 growth, flat, then it went to negative 6% growth. And as a result, the stock price tracked that, but notice how it goes up and down, up and down, up and down. So the bottom line is, as I look at this company, what I've done up to this point is determined that it's kind of a quasi-cyclical company. Now, as I look at this, the next thing I want to see is I want to see what the dividend record looks like. So I'm going to go down here and click the dividends and the dividend payout ratio. Now, all this means here, there's no estimate of a dividend for 2020. No analyst willing to give a dividend. So we kind of stop on our what I'll call our complete estimate data for 2019. So we have a full contingency chart here with estimates for all these years. For some reason I can't get this slider to work. There we go. All right, so now I've got data. I want you to notice a couple of things. You can see the slope of this line was high when we were in this growth phase, and then as growth flattened during this period, you can see that the dividend itself has flat. So, its relative valuation is important, but it's also relative to what kind of operating results the company is going to give. Nevertheless, this is a dividend paying stock. So let's go ahead and put the dividends after they've been paid out. What I'm really concerned about when I'm looking at a dividend payer like this, I've got a nice yield. I've got this dramatic overreaction, which is one of the real main focus of the article. We definitely had negativity here. We had very high valuation. And again, this is real world. One thing about these charts that I think people forget sometimes is this is actual history here. And when I scroll out all the estimate data, when I look from the historical data back, this is real stuff. So I can look here and see that, back in these years, this stock was commanding a 19 PE, but the price wasn't going anywhere either because it was overvalued. And of course, earnings were not really going anywhere either. But then we had this drop in earnings in 2017, and we're expecting a big rally in 2018. But the point is, as these quarters unfolded and the company showed weakness, the stock price reaction was dramatic. So even from the beginning of this year, get as close as I can here, from the beginning of 2016 to the end of 2017, this stock actually lost almost half its value, 46.5% of its value. Now, technically speaking, I feel the stock was overvalued here. We had a down year. I believe the price should have gone to this point right here. So in other words, I think a 17% drop would have been rational. And I want to really make that clear. That would have been rational because that would have been consistent with the operating results the company achieved. However, the stock, as you can see, fell dramatically from this point. So we've got this 1031 point here that I had, if I can hit it again. Well, that's close enough. And the stock ended up dropping another 35% from this fair value level, if you will. But notice now it's starting, that we're seeing an uptick. It's starting to recover, perhaps, and this is just a guess, maybe the idea that we're going to have a surge of growth here is in the minds. Now, that's rational because the company's made some acquisitions. They've talked about their most recent acquisition having the opportunity to generate $1 billion of extra revenue. So that's why perhaps some of the optimism that we see for future earnings. But if we get rid of all those earnings, and I think this is important, and just look at this stock, from the standpoint of actuals, no forecasting involved. The actuals, show this relationship, this 15 PE. We see the cyclicality of earnings, but this is a dividend paying stock. It's increased their dividend for 20 consecutive years. But I also want you to notice, as the growth rate of the company has slowed down, the dividend growth rate has slowed down with it, 9.411, when it was raising their dividend double-digit rates. So what's going to happen to your investment is always going to be relative to what happens to the business, notwithstanding these short-term periods where price and value get disconnected. Okay, but here's the point. This is a dividend payer, and so when I'm looking at dividends, one of my most important metrics to look at is operating cash flows. Are the dividends being covered by operating cash flows? Now, the Owens Minor story isn't real enticing to me because you see several periods where their operating cash flows actually turn negative. Okay, and you can see it's a very erratic, cash flow, and it has to do with the commodity nature of their business, etc. So their operating cash flows don't give me a lot of comfort that they've got plenty of money to cover the dividends. When I look at free cash flow, which loosely stated is what's left over after spending the money to run the business, I see several periods where free cash flow went negative. But on the other hand, if I want to take a more positive look, I see several periods where even after they've paid their dividend and everything else, they still had free cash flow left over. But this is not what I would consider a pretty cash flow picture. And then I go to EBITDA, which is a mild form of cash flow or even revenues, because it's really earnings before interest, taxes, depreciation, and amortization. It's simply showing you kind of like how the business is performing. And when I look at EBITDA, I see that about a 7.5 EBITDA has been normal. That's what this orange line is 7.5 times EBITDA. And I can see that, if you can buy it at a lower value, those were always good times to buy it. When price to EBITDA was higher than 7, you could make money in a short period of time, but you were always vulnerable to, some bad news. Here it was the recession. Here you just got a high EBITDA and it came right back into intrinsic value, went high again, came back, went high again, and moved back. And so you're going to see that pattern over and over again. But once again, you've got a very optimistic viewpoint of what EBITDA might be like for 2018 to 19. And as a result, you're starting to see perhaps the beginning of an opportunity for this to revert to the mean. This is the lowest valuation the stock has traded at in this entire 20-year history that we're looking at here. So when you're looking at this, the whole key point is this is an undervalued opportunity. I personally would not be real attracted to this company from a standpoint of operating earnings and cash flows. It doesn't really have the attributes I'm looking for. The dividend record is good, however, it's weakened over the last 3 or 4 or 5 years as their earnings have flattened out. You can see this flat spot in earnings. It's weakened, but you've got such a compelling opportunity because of this significant overvaluation. So if this stock were to earn this kind of money, operating earnings in this case over the next period of time, and I bought it today and it traded at a 15 PE, which you can see historically a 15 PE is not a reach. In fact, most of the time it trades at a higher PE. That's where the normal PE comes in. So I put the normal PE in here on the graph, and that's about 17. So you can see a 15 to 17 PE covers this company quite a bit. And I guess you can see when it gets higher than that, that's usually not good, notwithstanding the cyclical nature. But if I were to get this and the stock would move back to a 15 PE, my rate of return opportunity would be able to turn 10,000 into almost 18,000 in 2 years. That's a 35% annualized return. That's 80%, 79.8% pure rate of return, including dividends. 70% appreciation, a nice, almost $1,000 worth of dividends that would be paid because of the high yield. That's what makes this particular investment very attractive. So what I've done so far is show you the risks as well as the opportunity. The risk is it's a cyclical company and it has, it struggles with cash flow. It has periods where it goes into negative cash flow. I don't really like that. It has a great dividend record, but that dividend record has been slowing down. So let's look a little deeper. Let's go into the financial underlying numbers. Let's look under the hood a little bit. Let's look for margin. Okay, this is gross and net profit margin. And I'm going to shorten the time frame for you so you can see it. Now what's happened is in the last, 13, 14, 15, and 16, we had a nice surge in profit margin, gross margin, where the margin was, around 10%, gross margin, 9.7, 10.4. Then it jumped up to 12, and it's kind of stayed there through 2016. The net margin, however, is less than probably averaging 1.12%, but in many cases goes below 1%. So it's clearly a commodity business. This company does not generate, either high gross or high net margins, almost single-digit gross and, low single-digit net margins. So that's a problem. Now, there's some other issues that I'm not going to get into in the context of this video. But if I look at the balance sheet, for example, I can go in here and look at the balance sheet and I can look for, like, one of the things I'm concerned about is debt. And the debt ratio right now is about 47%. But let's analyze their history of debt. So I've got long-term debt and total debt here being graphed. And what you see is this company does have a history of taking on debt and then reducing that debt and then taking it on and reducing it. And as I mentioned, they've recently made a couple of acquisitions. You can read about those acquisitions in the article that I linked to in my written portion. But the point is they're building debt, so are they going to be able to pay that debt down and amortize that debt and still be able to continue to pay and grow that dividend, even though they've slowed that growth rate down? So the bottom line is this is an extremely interesting value investment, but I see it as a turnaround. I see it that it has become extremely undervalued. I see the dividend growth rate has slowed down, but it's still healthy. The company is still committed to raising their dividend. I talked about, you can read about that in the slide presentation link in the article. So Owens Minor is a very interesting stock today. Offers an extremely high yield, very low valuation, and an opportunity for some short-term gain, at least the next year or two, could be very promising if this company does end up growing earnings, like it says. So let's run some of those calculations. At a 15 PE, if it earned $2.15 this year, we'd see the stock being a $38 stock, and it's currently, 21. If I go to the normal multiple, which has been 17, then all of a sudden we see a stock that's worth $37 a share. But even using any of these multiples, I can see, the PE currently is 12. So what if we stayed at a 12 PE? It's about as close as I can get. There's 12.3. Over the next 2 years, I could still make 22% a year if I got no PE ratio expansion. If I get a little PE ratio expansion, that number goes up to 31%. And if it goes all the way up to its historical norm, all of a sudden that number's 46%. So I believe you've got a great risk-reward ratio here in this company. The estimates are, looking for a turnaround. It's based on those acquisitions. Nevertheless, I think this is a very intriguing company. It's not one I would awfully look at, but what I want to really get across the point is that price and value are not the same thing. The orange line is value, this is the price. And you can see that the price keeps leaving value and going back. Even if you want to say the price is lower today than it was, a year ago, it's still highly valued. Price and value are not the same. This has been Chuck Carnevale saying thanks for listening.